Hello everyone, welcome to another video. In this video we are going to do a short take on another Peter Lynch book. It is One Upon Wall Street. One of the chapters from this book where Peter Lynch discusses about 6 different categories of stocks. So I will first read out what he said. There are almost as many ways to classify stocks as there are stockbrokers, but I have found that these 6 categories cover all of the useful distinctions that any investor has to make. So it is very important because in these days when people are confused about how to create a portfolio or how to make a portfolio, this will be very useful as well. So he talks about 6 categories. The 6 categories are: first is the slow growers. Slow growers means large companies, very large companies that are growing at the GDP growth rate or very slow growth rate, but they will be high dividend paying companies. They can be found in some, maybe in consumer sectors or maybe in the mining or power distribution or all these sectors where reinvestment is not high, but they pay out huge dividends. So these are categories here referred to as slow growers. Then the second is stalwarts. Stalwarts are actually good companies that are growing at a better rate than slow growers. Again, he mentions that these are all large companies growing at a rate better than the GDP growth rate. Maybe he in the examples he talks about defensives like Coca-Cola and all from there, or Bristol Myers and all. So maybe here we can read like FMCG or pharma, or even something like an HDFC bank like kind of thing. So all these companies that are very large but that are growing better than the GDP growth rate, they are considered as stalwarts. And the third category is fast growers. Fast growers are always emerging growth companies, and they are always the favorites of investors because they are companies growing at say 20-25% annually. So this is actually the category from where investors will look to make most of the money out of it, and then it is difficult to get them at the right valuation. So that is always a challenge, but this is the third category Peter Lynch is mentioning about. So it will include all the emerging growth sectors, whether it is the upcoming IPOs or whether it is the fast growing financial companies, or this something like the retail chains or quick service restaurants, or the electronics manufacturing, whatever we see, or the consumer durables, or whatever we see as growing at 20-25%. These are the categories of companies falling under fast growers, and it is the one category from where you will be looking to make most of the money out of it. Then the fourth category is the cyclicals. Cyclicals, there are two types of cyclicals. Like one is the commodity cyclicals. You can find it in metals, oil, all these sectors, the commodity cyclicals. The other is the economy related. So you will see banks, something like a corporate lender kind of a bank that will be related to economy, or the capital goods, or the manufacturing, or all these sectors. So that is, something is based on the economy, something is based on the commodity prices like the metals or the oil companies. So that is another category that he is talking about. Then the fifth category is asset plays. So asset play in the sense, if something is holding a large land bank or something where it is looking quite undervalued, or something is holding valuable assets and looking undervalued, for example holding companies, or some companies sitting on huge pile of cash still looking undervalued, because we had such instances. We had during March, where automobile companies sitting at 20 or 35,000 crores of cash were available at very attractive valuations, adjusting for cash. So that is there. So this is what he generally refers to as asset plays, where the companies are sitting on huge underlying assets and then they are valued cheaply in the market. So the valuation is very important here. Then the last category is turnarounds. Turnarounds means companies that are in some kind of trouble, but they are expected to come out of this trouble through some kind of restructuring. So it can be sale of some portion of the business, or sale of assets, or it can be through recapitalization or entry of new investors, whatever these kind of things. But this is one category that one has to approach with utmost caution, because turnarounds rarely turn around. So very few companies from this category will turn around. So if you go and look at lot of companies from these distressed sectors and all, you will find lot of names, but that need not turn around. So you have to see whether some new investor is coming in, or what is whether the recapitalization or something is happening in the ideal way. So these are all very important. So a recapitalization just for a lifeline will not indicate a turnaround. So this is one category that should be approached with utmost caution. So these are the 6 categories that he has broadly discussed in this book, One Upon Wall Street, the chapter 7. And then in chapter 16 also he has given some insights on designing a portfolio. So there also he has mentioned these broader categories and all. So yes, we have got 6 categories. So you can have 6 or 12 or even 18 stocks. So there is an opportunity to use this classification to build a portfolio in equities which are maybe the categories are somewhat like non-correlated also. So that is also another important insight here, or another important inference that we can draw from these 6 categories. Also, in other aspects of portfolio strategy, like whether a concentrated portfolio is good or a diversified or all these things, you can also read the book Warren Buffett Portfolio by Robert G. Hagstrom. So that will also provide a lot of insights on the size of the portfolio and all. So that's it. So whatever stocks or sectors we have discussed here, that is only for illustrative purposes, and they are not our recommendations. For our recommendations, log on to primeinvestor.in, and if you like this video, please do subscribe to our channel. Thank you.